There have been a slew of deals already announced this week, and companies have been sitting on trillions of dollars in cash. We've been telling you that virtually every day and talking about the possibility of more mergers in the months to come. Let's look into it now with Rob Kindler. He's the global head of M&A at Morgan Stanley. Thanks for coming in.
No, thank you. Good to be here.
Last time we had you here was almost a year ago, October, and at that point you said you weren't quite comfortable calling it the trough of M&A coming off the peak in 2007. This has been an extremely active third quarter. Where are we? How do you characterize this cycle?
Well, the year has really progressed. Earlier in the year, there were still a lot of strategic deals happening. So we had deals like Continental United, deals like Quest with CenturyTel. So strategic deals were happening, but they were essentially stock-for-stock deals because people worried about relative valuations. Now we're seeing just a lot more activity going on. Just this week alone, I think there's lots of signs that the M&A market is finally coming back. So if you look yesterday, we had advised Unilever in the Alberto Culver deal, largest acquisition Unilever's done for almost a decade. But also on the same day, we advised Amtran on the Southwest deal. So there's just lots of activity at pretty good premiums, pretty good values.
And it seems to be that the activity isn't sector specific here, even though we are talking about industry consolidation. Is it just about purchasing revenue growth at this point?
I actually think it's beyond that. It is scale. I think people are doing deals to purchase revenue growth and not because of intrinsic value. That's going to be a problem, I think, at the end of the day. I think it's about scale. I mean, the deal with we advised Continental and the United deal, it's a terrific deal about scale and about synergies. That deal was approved. It's about to happen. But it is throughout all different sectors. Also, we just announced this deal in the aerospace sector selling McKechnie to TransDigm. Very good deal for TransDigm and a very good deal for the sellers of McKechnie. Again, high multiple deals. That's what we're finding in this market. You're getting double-digit EBITDA multiples for deals.
And what is underpinning valuations there? I mean, typically when you see market volatility, that's not the most ripe environment to have consolidation happen. What's driving the deal making in the boardroom?
Well, I think there's a couple of things. First, the market, we're an interesting inflection point in the market because we have maybe historically low interest rates. Well, who knows? I mean, people have been predicting all year that interest rates are going to go up and they keep going down. But we have very, very low interest rates. At the same time, we have low trading multiples in the equity markets. The S&P is only trading at maybe 12 times forward multiples. That's a very low forward multiple. So when you have a time when money's cheap, but multiples in the market are low, bidders can pay pretty significant premiums and still cut pretty good deals. So
talk to me about the private equity participation in here, because a fair amount of skeptics out there would say we're going to see even more private equity participation in M&A in terms of offloading assets right now because of the expectation that the tax environment is going to change. Is that fair? Well,
that's happened this year. There's been a lot of trades because people think there may be a change in the tax law. But I think what's more interesting is that private equity generally is back doing deals. So about a month ago, Burger King was sold in a private equity transaction. We advised Burger King in that, and that was a deal that was done where the leverage was over 6 times and the multiple was over 9 times. That's a $4 billion deal, one of the largest deals back. So private equity is definitely back in the game of buying companies.
Well, I want to talk to you about what them being back might mean and what's on the horizon. We have to take a quick commercial break, so we're going to Oh, actually, we have another minute, so I'm going to stretch more out of you there. Following up on that private equity is back comment there, when you look at that participation, when I've talked to investment bankers, they say, when you look at how to monetize an asset, IPOs don't look as attractive right now because the firms that own them end up still owning some sort of stake in that asset. Is that why M&A is more attractive to some of these firms who want to cash in these stakes they took on years ago?
Well, it depends on the asset, but it's a less risky path to go down the sale. Since financing is very wide open now, and you can do deals of size, $4 or $5 billion, it's become somewhat of a more certain path. But I still think there's going to be lots of private equity deals. Some of them may be pushed to next. I'm sorry, a lot of public offerings. Some may be pushed to next year.
Public offerings next year.
Next year.